Hi, this is Randy Finney with Right Side of the Chart, and this is a early session update, mid session for Monday, August 12th, 2024. It is 12:51 p.m. Eastern Time as I'm starting the video, and well, not a whole lot has changed, so I really haven't gotten anything out to you this morning. But I'm gonna recap where we're at, where my thoughts are at, where we're going. And reiterate, this is still an objective area, in my opinion, to, if again, depending on where you're at and where your outlook is, of course, to add back short exposure for those of you that did cover recently to game the bounce, as we did here. It's a good time because we're pretty much where we were last week when I said the same thing. So unless anything's changed, like how could I possibly see otherwise? In fact, it's even a little bit better today. We're continuing to back test this trend line. Let me start here. If you're just going to look at one chart on the market, we'll look at this one. We're going to go over a few, of course. That's what I like to do. I'm going to do an update on natural gas, the ag commodities, the grains, that is, crude oil. I just shorted crude oil. Took a shot here, not a hard all in, but a starter short. We traded that one recently for a beautiful 1 or 2 day trade, and we've come back to a level where I'll get to that one second. I'm going to turn off all the lines just so you can see what we're doing. I'll zoom in real quick, nice and tight. You can see that we are back testing the primary trend line here. I'm going to turn off all these lines and draw it for you on a clean board, and that comes off the lows here. You come in, capture this low right here from October. Come on up if you draw it that way right there. Oh yeah, and you want to come and capture that one as well. Again, depending on how you have it drawn, I didn't do a perfect job there. I'm going to try to redraw and show you where I had it here. Let's come off the top here and we'll do it that way backwards. And there it is. So you come in like that. And again, you can come in here, absolutely. And I do have one, this right here from the October low that comes in a little tighter and captures these lows. And so that's kind of the range. And so all along I maintained, and I still do kind of a scale in range. You've got multiple trend lines. You've got the downtrend line off the highs, and nothing has changed. To kind of recap, this is where last week I closed that trade out earlier, had a second target up here, which is still, actually it's now been hit. So there's the old T2 zone, and we've hit that. So when I closed that out last week, I said this is the, my scale in zone where I could easily see us going up to, and would really to keep the, the technicals strong, the case to, short another leg down, really not want to see that area get violated and that downtrend taken out. So like I said, it's really kind of the way I look at it. You start out with the bigger picture, where, the roadmap, where have we been, where are we going? And if this is a counter trend bounce with another big leg down to come, or multiple legs down, then again, this is just the optimal and likely bounce target zone. So we're there again, hit that old T2 zone, which is just, we're not talking much. It was only 1% above where I pulled the plug on it and revised it down to here last week. So that's it. So not a whole lot's changed there. We kind of, the market has that bid underneath it. All the reasons that I said, closing out here in pre-market when we're below that low, that, hey, we're in close proximity to the 200-day moving averages. My multiple price targets on the S&P 500, NASDAQ 100 futures were hit. These companies, Apple and Meta and Amazon, they all have these stock buyback programs are going to be firing off. Those that have missed out on this run on NVIDIA and all the big tech stocks, where are they going to buy if they don't buy here? So they did, and they bought it. And again, the $1 million question, I like to get precise, but this is a bigger picture trade, so I'm giving you a scale in zone and using that kind of, and when I'm, not 100% on where exactly we're going to turn, then that's where I use that scale in, scale out thing, scale out of shorts, scale back into longs. And then, if wrong, we start going up more, some things develop in the charts that I didn't see, or new developments occur that convince me we might go up and bounce more, or even go to take out the new highs. If this is, as now they're coming out of the woodwork, of course, look at the headlines, and now they're all talking about buying the dip, and it's a great dip buying opportunity, and Wall Street Journal focuses on some guy that's been buying dips since 2008 and how well it's worked, and all that crap comes out now, a week later after we've already bounced, again, from the pre-market lows where we reversed, it's been about a 9% bounce. where were they 2 weeks ago? They thought the sky was falling. But anyways, that's that. There's all I can do is give you the levels, give you my thoughts, turn off all the lines, and tell you, we've got some price, actually some fib resistance too. Let me go flip over to a different board. I've showed you fibs lately on the futures. These are the fibs, which are Fibonacci retracements on QQQ. So if you measure from the highs right there, the all-time high right there, that was the daily bearish engulfing candle, sell signals galore around that time and just before and after that. You've got the fib comes from that point, measured down all the way to the recent lows. Again, when you're using QQQ, you're going to have a different Fibonacci retracement levels because the futures are going to show that plunge that we had into pre-market and overnight and pre-market session before, and going to have a little deeper drop, right? So just want to point that out if you're wondering why they don't align. So that is in yellow. I know it's hard to see in the video. I wish I could make these numbers bigger, but I can't. This yellow line right here is the 38.2, which we hit to the button today. So that's been hit. And then if you take, which I was doing recently for you on the futures, this spike, we had that last impulsive leg down, again, comes off the highs from August 1st. And you measure, put up the purple line right here, gives you that fib, and you have the 61.8 right here. Again, I know it might be hard in the video, so I'm drawing over it. And that's, we kind of split the crosshairs if you look very closely between the two. That's what we call, guys, a Fibonacci cluster. When you look at, take these multiple key reaction points like I did, and you put up fibs, and fib traders like to look at the clusters, and then of course, because they do, so do I. And these fibs work. I'll tell you what, man, it's uncanny how well they work, and whether it's a chicken or egg thing, whether they always worked, and there is something behind the Fibonacci ratio and sequence that I know. It exists in nature and science and all throughout the universe. It's kind of odd how things work. You can look it up, Google it. Everything from the veins in a leaf to the shell of a nautilus, have Fibonacci sequences. And it's pretty interesting. Anyways, so that's how traders use it. And again, whether they're self-fulfilling prophecies or not, doesn't matter. I like to align them with price resistance and support levels. So, and that's what I'm showing you there. So there's QQQ. I think I did it on SPY. SPY, yeah, I did. Okay, same levels from the recent highs and then that reaction high there. And you can see right here, you have a cluster of the 50% off the all-time highs and the 61.8 off there. So two key fibs that were a little shy should the market want to push up more. But remember, to me, it's all about QQQ. SPY, the S&P 500, kind of a, secondary index, if you will. Very important, don't get me wrong. A lot of traders trading it and, index funds and all that good stuff. But I just wanted to mention that we're in that sweet spot, if you will, guys. That's kind of the takeaway. The 50, 61.8 fibs, 32 on the NASDAQ. And I think I even did RSP, equal weighted. No, must not have, but I'll put it up for you here. I might have done it on another board. So there's the all-time highs right there, down to the recent lows. And then you really don't have, the equal weighted doesn't have a distinct secondary punch up there. Maybe, maybe that's why. Yeah, because the equal weighted peaked actually later than the other indexes. There it is. Either way, I just want to put up. But what I do have for you on the equal weighted, I think it's interesting, is this chart. Again, RSP is your equal weighted S&P 500 ETF. And that was a big divergent high that it put in right there. So it would be DH if I were to label it as such. That was a divergent high too. There was your trend line break of the bearish rising wedge. If you don't see what I'm seeing here, let me just draw it out for you real quick. So you had this bearish rising wedge and a nice divergent high. Had the potential to be the high, had a healthy correction coming off there, similar to this one. But what happened, we put in, as expected, if we made a new high, it would be an ever so slightly marginal and still very much divergent high. The divergences that were in place back here in April, late March, early April, not only were taken out, or were not taken out, I'm sorry, not only were they not taken out, they grew much larger and more powerful. And so this is really DH2, or simply an extension of those big divergences. And although it's not guaranteed, typically the bigger the divergence, the bigger the drop. So if this is what we got off that seemingly small, relatively, or smaller divergent high, you would expect a much larger drop here. So that's it. And then I have this downtrend line I've had on RSP, the equal weighted as well. Right there, we had boom, 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 and then a breakout, successful back test, off to the races, so they thought, but boom, smack down. Hard rejection at the line right there, and now we're back testing that line from below with this little wedging type action. So, and I can even put a price support level there. Why did I do that? Well, you had a reaction low, distinct reaction low there, several reaction highs here, and those were the previous all-time highs right there, followed by a breakout. So, multiple resistance level. To repeat, I like it here. I have, even though we're 1% higher than we were last week. So to me, I've added a little more swing short exposure. I'll be honest with you, I think this is about it. Could be wrong. You know, my job is to tell you how I feel, what my thoughts are. Give you, first of all, analyze the charts, let you make up your own mind, but then I'll always share my 2 cents for what it's worth. You know, everything I've talked about in recent weeks with the VIX spiking, and when that happens, we'll go to that. Let me just jump over to the VIX. I don't want to get to the small caps for you and the other stuff, but like I said, this is no, VIX dot. There we go. As I mentioned, it could be a one and done event, and I'm talking about this recent spike in the VIX. Let me turn off all the lines. This is the weekly chart of the VIX, but typically, you know, this little thing here to me looks like the shot across the bow, and usually when volatility starts to spike, it changes the interdynamics of the market. It's now, you know, where you have months and months of just a slow grind up in the stock market because of the declining VIX. It's called the short vol trade, is what it's known as on Wall Street, short volatility, where the the big boys are shorting the VIX, and then once that turns, it unwinds. It just has a different dynamic in the marketplace, and part of that is, and you have big pension funds, for example, which control, I don't know the number, it's huge amount of assets, and even hedge funds and things that are flexible like that, repositioning to mitigate risk when it's a risk on market and the volatility's low and credit spreads are as tight as they could be, as they were recently, and all that stuff. And they have widened, by the way, guys. I do watch that. Now all of a sudden they don't take as much risk. They start selling what they're heavy in, especially the high-flying names, NVIDIAs and Microsofts and Alphabets of the world. And we've seen that. And of course, I'm not telling you now anything you don't know, even though it was predicted in advance, but I'm also telling you that it's usually not a 1 day or 1 week wonder, is what I'm trying to tell you when you see this kind of move in the VIX. And so, well, we can try to thread the needle, but you already know my thoughts. I'm not trying to fish out and get hard, wait for a certain bounce that might be a little higher in the NASDAQ 100, because I do think the bottom could fall out at any moment right now. If this market turn plays out like others, and if there is much more downside to come. If you happen to be new to the site, for months now I've been sharing my long-term targets right here on the NASDAQ 100 as well as the S&P 500 NVIDIA. I started sharing these targets back here in late June, right before the top. I posted a market top range, which would be, my guess, as high as the market was going to go, and it did go to within 1.5%, close enough on the NASDAQ 100. We hit my first and second targets already, and this is the counter trend bounce. And when you see, this is the weekly chart. Here's that same trend line I just started the video with for you on the weekly chart. You can see it right here. It's the yellow trend line, comes in, captures, starts off the late December, early January lows, comes in, hits that key October low, comes in here, and that's the way that one's drawn. I have an alternative trend line really coming off that October low that comes in a little bit higher, and could certainly see the potential for that. And if it does, then that's an area to add more short exposure, but not really at this point in time, not above that. All right. What else do we have here? From the downside, from the turn, we have the 23, which is a minimum. I don't usually even put the 23.6 fib up on my charts. So what I'm talking about here is the move off that low right there, that major bottom there. And that's, this was the low in October. Same with the stock market, the S&P 500. It was in October. The NASDAQ, remember, pretty much double bottomed. It was just a slightly higher, almost equal low back in January. So to measure the fibs, you want to go off the low, up to the high. And I just want to point out that we came through and had a little reaction. That was when T1 was hit, was with the 23.6. 38.2 fib is right here with my third target. Now, again, if I remember correctly, yeah, that was hit, I believe, in pre-market when we covered, and that was one reason for covering. I think T3. I know it was at different boards. Of course, it gets confusing sometimes. From me, I give you different targets for different traders. I use them all too. But where was it on this 60-minute chart? Yeah, that's what it was. Here it is. T3, same level, about 413. We had an intra day pierce, but it was about a perfect tag, about as perfect as you can get on NQ. Those are the NASDAQ 100 futures on my daily chart. So we'll go to that real quick. Let's do 6-month daily candles. And again, these were the same targets. Well, nope, I got to go back farther. And again, I do this. This might be repetitive for some of you, but there's always new folks coming in, or those. I got to go to another board here. Somewhere I'm going to have this for you. I didn't have all these charts queued up. 1 year daily candles. There it is. Okay, so on the 10th, or was it the 9th? The day before, literally the day before we peaked, gave you these, I laid out targets, swing targets, longer term, what I call longer term swing trend targets for the NASDAQ 100, all the way down here to T9. I added one since then and along the way in here somewhere, but this one all along was hit to the button that day. And that's what I'm talking about. That's where we covered the lows, and that doesn't reflect on the QQQ because it was, these are Globex trades, are trading around the clock, the futures. So early that morning before the market opened, that's where we covered up in reverse. And this is the bounce we won the game. And this is big resistance right here. That was a big target for me. Remember, we covered here too, covered shorts, gained that bounce. That was the biggest bounce since the top, and it was really good support, or better, it was the best support yet. I should say, on the way down. Look, T2 was a pretty decent support. We also had a tradable reaction off there. This one was better support. We had a bigger bounce. This was really good support too. We had another big bounce, and that's it. And the way it works is, point all this in these videos, is support once broken becomes resistance. That's technical analysis 101. So therefore, as you can see, we're very close, not all the way there, but very close. And again, that's why I have a range if the market wants to push up a little bit more to that 18. I'll be honest, we came in, there's a 23.6, but yeah, 18.867, that was T4 right there. And let me move this over. We're very, very close. Again, I have to squint to see it, and maybe we push a little higher. I mean, anything's possible. We can blast right through there. But now, since my analysis was correct, the T4 was a significant support level, and it was. Remember, we traded on this. These are daily candles, one, and then above it, test it again, test it again, test it again. Then we gave it up. All these reactions helped to validate it. So my point is, if I thought from looking at the chart, everything over here to the left before we even got there, that this would be a significant level, it is much more significant now. Everybody can see that that's where we dance. So there, what I'm trying to get at again, this is significant resistance, and we're so close to that. So again, doesn't mean we can't punch through it. And if we do, then that says, look, this rally's got a little teeth, and we're probably then going to go up to the next resistance level. And if we take that out, the next one. And at some point, it starts to change or alter the the layout on the daily and weekly charts, and may help support the case that maybe this was another great buying up on the road to new highs and beyond. Right now, I don't see it that way, not even close, but I'm certainly open to that. And any possibilities, I always am. So I just wanted to point out, spent a lot of time doing it. This is we're at that level where if you were looking to get short or close out longs on the bounce, this is objective. And the other way to do it too, and I've always said, if you were in off the lows or anywhere since, you can always just trail your stops up and let it run in case we are going up higher. How tight? That's up to you. It's simple. The tighter your stop, the less you're going to give back if we reverse, but the better chance you have of getting clipped out, on just the day-to-day grinds. Remember, the volatility is still high. The VIX, although off its highs, is certainly still elevated. This was our VIX trade, and we're coming back, and I keep updating this for you every day too. We booked 50% profit on it. Right here, we went up and hit that previous T5 I gave you, And as I said, anywhere from here down to here would be an objective re-entry point. And we just hit today to the button on a pullback. Which one was T1? T4 was here, T3 was here, that was T2. Oh, this was T1 then. Bam. I mean, right back to T1. And then you have the trend line below. I'm sorry, T2. Now, I also go off the spot fix. I put more crude in the spot fix as well as the VIX futures. But you can see something similar here on the spot fix, which I'm drawing up for you here. Same trend line off the low. Actually, we're at the uptrend line off the lows. And remember, the reason is the VIXY is one of many ETFs or ETNs that track the VIX. Does a good but not perfect job of it. So you can see here, we're, again, close enough if that's your plan to recycle back into the VIX. Obviously, problem with the VIX, even if we start to slog sideways now for a while, it may continue to move down because volatility has subsided. But I like it here. I just want to mention to you, it's time to get back into that. And for you futures traders, you have the September VIX right here. Beautiful breakout there. Remember, we had, this, I had updated charts I'd given you before. This is my trading proxy here. We had positive divergence. It's not shown. I've kind of zoomed in a little bit here, but this was big resistance. Boom, and then boom, breakout. It wasn't just a breakout and muddle around, kind of meander around. No, we exploded higher, and we are coming down back to test that breakout level. If we happen to overshoot it by a hair, you've got a nice uptrend line below. So again, this is doesn't guarantee it'll play out, but I can guarantee it's objective to be re-entering the VIX around these levels. Again, it's going to help to see the stock market roll over. If the stock market doesn't, the VIX is going to head lower. So don't get married to it. Don't fall in love with it. Or you can wait if you want to see better evidence of a reversal in the market. Okay, I showed you the equal weighted RSP. I think I showed you, I'll get the SPY. I kind of maybe forgot to do SPY, but this is IWM. Small caps, Russell 2000 ETF, divergent high there. We broke this trend line right here, uptrend line we're back testing right now. That's a daily chart. When you look at the weekly chart, this is what it looks like. Still off the all-time and divergent highs from all the way back in 2021. And you have negative divergence here on this weekly, at least on the RSI or the PPO right there. You can see it drawn. Negative divergence there, and what we really need to do is fall solidly back into this previous trading range here, and then that should bring us down to the bottom there. So we're kind of on the weekly chart. I showed you the daily, we back tested that level. The weekly, we have some support here about 199 we need to solidly take out in the 200-day moving averages, and then the S&P 500. Let's do that, and then I'll move on to everything else. S&P 500 weekly chart, again laid out and give you this final market top range back in late a couple months ago. All right, so we hit T1. I said PMK in pre-market, but we went through it after that too, so I can just take away that pre-market part because it was hitting the regular session. We bounced right off. These are your 200-day moving averages to the button, kissed them, bounced as expected. That's where they buy. That's where they bought last time, and that's where they buy in a bull trend. And the million-dollar question is how much more. So like I said, we could go up. We could remain above them. We could rally or even trade sideways for weeks, maybe even months. I can tell you that once the 200s go, or just say the recent lows, being the fact we've already tested them, that'll probably be the next catalyst for a move down to these targets here, T2, T3, T4, T5, and T6. UNG natural gas, we're still long that one. Remember, big divergent low. We had a divergent low here. We had one here. And it's not like either of those didn't play out for a nice rally. They usually do. And that one played out for a 22% rally. This one here, off the divergent low, we rallied about 56%. We caught that one. I believe almost every penny of it, or most of it on that one, got out. We had a divergent high at the end, went back down, and we're long again off the divergent low, and using 60-minute chart for targets as well as the futures. We had T2. We were up a little more in pre-market today. We're right within spitting distance of of T3 in pre-market. And I'm going to do pre-post data here, and you can see it. I just opened a beta version of this charting program today. So, always show last two. There it is. You can see, for all intents and purposes, that's effectively a hit. I always say sell a little shy of the actual resistance levels. The high was 1493 this morning, of a target of 1505. But for whatever, it's still, I still like it. I still maintain these additional targets. We're zigzagging higher, and still looks good. Let me turn that back off. And for you futures traders, I've given you two charts. For more or less active swing traders, a 6-month, 2-hour candlestick chart, and then a 60-minute chart with more of a what I call micro levels, a little smaller resistance levels, targets you might want to game on the way in. And that's it. So it looks good. Coming off that divergent low, nice breakout. We back tested that. The buy point was a break above the trend line and or that 230, and they intersected 203 resistance level. Went up, hit T1, had a little pullback, came up almost to T2. We're back to T1, which is should be support. And that provides an objective add-on or re-entry if you took profits this morning. And these are still the next targets, and I'll probably make that officially T4. We've got a little time. But looking good. A little near-term uptrend line, maybe bring in a little more selling if it's taken out. We could draw a trend line off the lows if I want, but again, based on the scope of the pattern and the fact this is coming off long-term support, not just the 60-minute stuff that we're looking at here. I've showed you on the daily chart that the $2 area is good long-term support. I'm open to the potential. We can have 100% plus, gain in this trade. And so depending, if the charts continue to hold up and still look good, I'll most likely be extending targets. And that brings me to crude oil. Crude oil, our last trade, we nailed it. We were long here at that low right there, that divergent low. We milked it right up to T2. I gave you a first and second target zone, in which case I stated closing the trade out. That was my final target. Turned around and fell hard. Had this divergent low recently. I believe I highlighted that for you last week or a week ago. And boom, exploded off that divergent low. Look, we're at right back into where we stopped before, which was not a random level back then, and it's certainly not now. That is the top of that T2 zone. And so I took a starter short position right before this video started right here. I will add up to, but not above this downtrend line. It's a relatively small range. And I will also add, so I'll scale in on weakness, if you will, or strength of that. When you're shorting, it's like buying on weakness. I only do that if my plan entails that ahead of time. And so up to there, and then and or means and then or a break of this uptrend line right here. Targets are kind of TBT, to be determined right now. If it pops the trend line, it's probably going to run up higher, so I'll let it go above there. So I just want to mention that. Minimum target somewhere around here. Just looking for a pullback trade. There's a lot of conflict going on right now, or potential saber rattling in the Middle East. And I'm sure that's part of why they're putting a bid under it. But on the flip side, the economy has clearly been rolling over. So demand destruction is something, a very real threat to crude oil prices. But in the near term, it's geopolitical risk driving this thing up and down, I think, more. Plus, remember, the stock market rebounded. So everyone was like, 2 weeks ago, oh God, a recession's imminent. We're going to have a hard landing. The Fed's going to do emergency rate cuts, blah, 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 all that nonsense. When we, drop down, technically induced drop in the stock market. And that took crude down with it due to the implied demand destruction. And then, of course, markets rallying and, the Fed's going to cut, but it's orderly now and everything's good. And it was a great buying opportunity. So you're seeing crude rally because it'll do that in sympathy with the stock market. Because if the stock market's going up, that's implying that, or it's showing that traders are assuming future economic growth. Hence, the stock market up, crude up goes hand in hand. Stock market's up, economy's growing, more people are flying, traveling, taking vacation, jumping on planes, trains, and automobiles, and so crude's in demand. But that's all. See, that's the fundamental stuff. I'm kind of mocking the media is going to react, but I follow those ebb and flows and I factor in. And so I just wanted to point out that's it. So looking for a little pullback trade. If you want a quick trade, minimum target, just be a pullback to the trend line. Can't make a hard case yet. We are very overbought. You can see that as I'm looking at the RSI right here. Last time we were that overbought was back here. Here, I'm circling what happened, and then see that time you were overbought, but then you pushed a little higher, but marginally higher. So I can tell you right now that would be a beautiful scenario to see this. Little pullback soon, maybe check the trend line, push up, make a marginal new but divergent high on both indicators. So I'm trying to draw my drawing tool here. Get you some nice divergence going here, something looks like that. And then that right now we have just divergence right there on the PPO. So again, that's why it's not a hard all-in short trade, just a start here, add up to if we can get a divergent high soon. But sometimes you just get the overbought reading, like right here, right? See that one? Overbought, same level, extreme overbought, one and done, and boom. So that's hence the reason not waiting. Divergences aren't the be all end all. They're not an absolute necessity of a top or a bottom. They're just a likely condition. And then you look for the sell signals, such as or objective entries, such as a break above, break down below a trend line, or a rally into resistance, such as price resistance or a trend line. And for you ETN traders, for crude, USOs, want to go to options. Months back, I gave you these yellow, orange, and red zones. And we've been trading off them too. They're not just arbitrary levels. They're based on technical analysis, but fundamentals too, saying that, the more crude pushes up, it's that vicious cycle or negative feedback loop I gave you starting. It was been over a year now. I give you a negative feedback loop between inflation, the stock market, and the economy, and inflation expectations, real or perceived, and then the bond market, what interest rates are doing, and what the Fed's going to do. And so this all ties in. So we've seen this run up here. Crude now is back to where the high end of the range is. Remember, these are near multi-year highs. This is where Powell and the Fed, they were in denial. Inflation's transitory. Back here, right? All of a sudden, they realize, oops, my bad. It's real, and we're going to start raising rates. And they did it. So the market started screaming and having a fit. And then it rallied, but then we did this and went down. And again, we've been gaming this like a grand piano, playing the market like a grand piano or a fiddle, whatever you want to say, with looking at these zones and waiting patiently, but also trading crude off there. When it rallies back, it's resistance. So we're coming up to that 79 resistance level, and that supports the, scale in from here up to that level, not much above it. And also, again, you can view it almost as a hedge trade. Let's say, for example, we've done this before, and it played out beautifully. Over the last couple of months, I've laid out this paired indirect hedge trade, being short the stock market, long crude oil, because if that happens, if crude continues up, it will have an impact on the stock market. There's going to be more rhetoric out there about, oh my gosh, how is the Fed going to cut now? We were looking for a week ago, we were at I did the video, the odds were almost 75% for a 50 basis point cut. That's now pulled back to 50-50, I heard today. I didn't check it, I read a headline on that. So that's come back. Now you see crude do this, and let me tell you something, 50's off the table. So if crude goes up, you're going to profit from a crude long. Again, if you want to do that, I just showed the case that it's probably going to hit pull back here, have some resistance, or at this point you can short crude based on purely the technicals, and that would be if crude does have a big leg down, that could support an extra rally in the stock market. So then your index shorts are going to go down, but you're going to profit on crude, right? Does that make sense? Because if crude has a strong reversal, that will help. It doesn't guarantee it, but it's going to help support the Fed's case to maybe do a 50 basis point rate cut. Crude up makes it harder for them. And again, technicals show us, this is a decent level. This is USO. I go off, really put more weight on the CL chart, but we had some support here, support there. We broke it. Then we kind of back tested in this area here, a little shy of it. So it's resistance, not hard resistance, but mild or moderate resistance there. And you also have a comparable uptrend line like I gave you on the futures there, in which to trigger a sell signal if and when broken. And you also have, similar to futures, some extreme overbought conditions here. We'll color this up. Let's make it purple or something that stands out. and just show you what's happened when crude's gotten here. So we'll roll back and just kind of highlight it. Remember, oversold or overbought is not a sell signal. It is merely a condition, just like divergence is. But when you get there, it's usually either one or done, or you push up, make a new high and a divergent high. And you can see, well, these were all on that level. So I'm circling all the tags of this purple line we had. That one was just a hair below, close enough if you want to circle it. And we're there, and I showed you. Sometimes it's one and done. Quite often it's one and then a little bit lower one, then comes a divergence. So like I just laid out before, that's a potential scenario. So if we can zig on up here, maybe get a little correction, one more thrust higher, then I will be revisiting whether I'm stopped out or not, or this trade stopped out or not. Based on the parameters I gave you, I'll revisit that if we get something like that, the divergent high scenario. And I'll say this too, based on, I told you, kind of targets to be determined. Right now, I'm just looking for a reflexive pullback trade, and I'll probably, take a quick buck on it, and then either do that or set a stop and let it run a tight stop below, and let it, if it continues to drop, then I'll just periodically lower my stop on that one. Probably spent more time on one. It took such a small position. It's not even a big one. Then wheat, corn, soybeans. I'm still lukewarm on them, not hot. There's that divergent low. We're still coming up on them. They're just kind of there. Long-term charts are still constructive. Big positive divergences all the way out here on the daily chart. That's wheat and daily corn. Big divergent low. Corn needs to take out this downtrend line, bullish falling wedge pattern. This is what it looks like on the 60-minute chart. You still got the divergence. That's the wedge I just showed you on the daily right there. So if corn pops that, it should run. But these guys tend to go together, corn, wheat, and soybeans. They usually run in sync. And they keep doing this, but in these divergent lows, and they give us rallies. They run up, they hit these early targets. And one of these will be the turn. When I look at the chart, the long-term charts, like soybeans, this was the first corrective wave in a new bull market. Then we had another thrust higher, and we're back to that level right now, you can see. And corn as well. You have, I'll turn on the lines. You've got some support. This was an old support level here. We were so far above it, I de-highlighted the color, tuned it down a little bit, but it was a big level. You can see that back there. So that's it. So these guys have been beat down. They were hot when the inflation trade was hot, and then as inflation cooled, and this is part of inflation cooling, they went down. But as I've stated many times, when you look back long term, they were in a bear market from right here all the way down to the COVID lows, and this is all the makings of a new bull market and a corrective wave within a new bull market. So, and it's, like I said, they're not screaming buys now, but they're also a way to diversify a portfolio. A lot less risk than a Nvidia or some high flying tech stock, and zero correlation to the stock market. All right, I'm going to wrap it up here, get the video out to you. This has been Randy Finney with the Right Side of the Chart. Have a great day.